Well, hello and a very warm welcome to today's webinar, Data Center Financing in Europe, brought to you by Scope Ratings. My name is Keith Mullin and it's my pleasure to be your moderator. Now, this session is, of course, very timely given that the general narrative around data centers has moved firmly under the spotlight across a number of key sub-themes, one of which is who's going to fund them and how, which is the core topic of our discussion today. And a key milestone in the financing arena came in the summer with the first data center securitization in Europe from Vantage Data Centers, which was rated by Scope. We have a fabulous panel lined up for you, which I'll introduce in a moment. But before I do, let's just quickly run through the agenda. And so we're going to kick off with an overview of the securitization that I mentioned that Vantage did in the summer. We'll move on to the broader topic of how European data centers will be financed and what options are out there. We'll discuss the state of the European DC market and what the challenges and growth drivers are. And then we'll be happy to take your questions. So as your questions arise, please do type them into the questions box and we'll be happy to address them at the end. And today's session will be conducted predominantly as a Q&A between our panelists, who I'm delighted to introduce to you now. So a very warm welcome to Guillaume Genin, Director of Capital Markets at Vantage Data Centers, Tobias Buter, Director Asset Securitization at SMBC Nikko Capital Markets, Syed Ahmed, Managing Director at Aptera Infrastructure Capital, Benjamin Boucher and Adam Pleiner, who are structured finance analysts from Scope Ratings. Hi all, thank you so much for giving up your time today. Looking forward to a very spirited discussion. So let us move straight into our conversation. I'm going to come to you, Guillaume, if I may, just to kick off, just to set the scene and perhaps give us some background about the motivation behind the securitization, and then perhaps we'll move on to, a bit later on to broader topics. But yeah, so your deal in June, it'd be great to get some kind of context from you.
Yeah, happy to. Look, I don't think I'm going to shock everyone with that statement, but our goal was, to place a debt product that would maximize returns. So what does that mean? It's a combination of best leverage and flexibility from a dividend yields perspective. So I think that's obviously the primary driver behind it. I think number two, which is also very important to us, was to diversify away from the bank market and essentially show our banks that we are able to take them out into the market. That helps them to bank us because they have a clear example that we can manage their refinancing risk, and two, that also helps us because they can recycle their balance sheet and redeploy on our future construction financings, given the high growth profile of the industry and Vantage at the moment. And then look a little bit further, beyond just the institutional market, I think it also helped us showing the market that we are able to, crack the code of new products, unlock new liquidities. And I think that also gives comfort from an investor's perspective towards Vantage that, we have different lever to pull when it comes to financing our project with debt.
Okay, just before we move on, in terms of the preparation time and getting the deal into the market, was this on a kind of on a long burn, or were you able to get it structured into the market pretty quickly?
No, look, trailblazing is never easy, right? So although we had done around 10 issuances in the US, we had never done it in Europe, and no one else had ever done it in Europe. So we had to bring a lot of third parties up to speed, rating agencies, the banks, the lawyers, and whatnot. So look, it took more than a year to structure, right? I think in total roughly 18 months of structuring discussions. So it was really a long-term effort. And look, I think what really helped, right, was our ability to leverage on the ABS transactions we've done in the US. So just bringing over the precedents, the documentation, having chats with the established investor base, making sure that we understand where they want to deploy capital, what type of structure are investable, and trying to reflect that in Europe. Yeah, we did a lot of early marketing, right? So we didn't press the button on the ABS without having thoroughly sonded the market. So we did, I think, 100 plus one-on-one meeting before launching the deals, through ABS-focused conferences. So I'm thinking about Barcelona and Las Vegas. And during those conversations, plus looking a little bit or pricing levels from the US, we could get a good sense of what would be a conservative pricing level to start with, to make sure that certainty of execution is properly managed here. And then from there, and as expected, we really got a lot of demand. So we were able to further lower pricing as the deal progressed. And then in the end we priced inside of guidance at 225 over, and there's probably a lot of that 225 which is still pertaining to the fact that this was Vantage being a first-time issuer in Europe, and data center being a new asset class in the ABS market as well. So look for next ABS. I think we can break that marker quite easily as well.
Yeah. Okay, thanks. And Adam, obviously a critical factor of this was the rating, and so can you speak to the rating perspective and your part in this transaction?
Yeah, sure. Thank you, Keith. So the first thing which we had to do when we started looking at this transaction was that we had to assess what level of construction or refurbishment type of risk is involved. We determined that given that there's only some kind of limited fit-out risk related to the properties, because we already have 2 operational good data centers, these kind of risks are kind of limited, and therefore we are able to rate this under our commercial real estate rating methodology, which we also use for other type of assets, commercial real estate assets. So what we did under this methodology, that we followed our standard bottom-up approach, where we look at the sponsor, we look at the credit quality of the tenants, the properties, and also the structural features of the transaction. And based on all those, we conduct our cash flow analysis. So this is what we also did. In this case, we assessed the risk of default during the term and also at refinancing. Here, what we are doing is that we start from the contractually agreed leases, and we consider that the leases will come to an end at the first take option, or in the case if the tenant defaults. We do a Monte Carlo analysis in which we model each tenant based on their credit quality, and we determine for each period whether they would default or not, and how the cash flows will come based on the lease expiries or breaks, because we assume that after a lease will terminate, there will be a certain void period, with no income from a given unit, or in this case, for data centers, we obviously base our analysis on the leased out power capacity. So we start with this initially agreed contractual rent, and then after lease expiry, there is a void period, and then we assume that it will be relet, that data center capacity will be relet to next tenant. In the case of this transaction, we saw that we are in a very good situation in terms of term default risk, because we have a very good quality tenancy in the property. Most of the rental income comes from investment grade rated tenants, particularly from the largest tenant, which holds AAA public rating, and the leases are long-term leases. So it reduces this reletting risk. In terms of the data centers, we applied some stresses to the completion of the fit-out works. So we accounted for potential delays in the fit-out works, which now we see that we were cautious with these stresses. That's what we apply in line with our methodology. But at the moment, we don't see significant issues with this, of course. In terms of the structure, I would say also the transaction included protective features in terms of the LTV covenant, and there are also certain debt service levels which need to be complied with. Otherwise, the notes will start to amortize. This is also something which we factor in our analysis. And also one important point is the outlook, the market outlook, which I'm sure that we will talk about a bit more during this 1 hour session. But what I can say from our perspective, that in the short term, we are optimistic on the data centers. So we see that there is a large demand on the market. Artificial intelligence obviously is driving this demand. However, on the longer term, we are a bit more cautious. So we also applied sustainable rental value haircuts to the market rents because, today we are in an environment which is very benign for data centers, but in the longer term, the potential technological development can lead to a situation where this demand would decrease. But this is not something which we expect on the short term. So, we were able to rate this transaction, and we look forward to rating the next one.
Good. And the rating was?
It was A flat.
Okay. No, I thought just state that for the record. Anyway, good. Thanks, Adam. And well, let's move on to our next session. I'm conscious here of our time, and I wanted to bring in Saeed here. So thanks so much for your patience, Saeed. You've been there very patiently waiting. So look, I just wanted to move on to the broader topic of financing the European DC market, and of course, the US market is some ways ahead of Europe in this context. And if you think about it, I guess they can be securitized, the private placement market, corporate bond market, the bank loan market. There's a number of different options out there. Can you first of all talk perhaps a bit about give us some background in the US market in terms of how that's evolved, in terms of how the financing is split out, and maybe give a sentence on Aptera itself as well, so everyone is familiar with exactly how you engage with the market.
Absolutely. Thanks, Keith. So just quickly background on Aptera. Aptera is an infrastructure debt platform for Apollo. It was started about 18 months ago. And really our mandate is to go invest in infrastructure debt transactions across the cap stack and across geographies as well. So while I'm here in New York, we have a team now in London who will be looking at European transactions, and we'll actually be starting a team in Asia as well. So we'll have a global footprint on when we look at infrastructure debt. And we're split up into different verticals. I lead the digital vertical here based in New York. And as I mentioned, given that we're, Aptera is funded, we have our own balance sheet, but we also, because we're part of Apollo, can leverage Apollo's balance sheets into transactions. So we can look at transactions from very different perspectives and try to offer solutions that way. So when we think about the US market, to put it in context, obviously there's a lot of data centers that are getting built and need to be built. We saw the evolution years ago when cloud was becoming a thing, and then obviously that's still in the background, but AI is taking more of an emphasis now. So even from a capital deployment standpoint, a lot of it was going into tier 1, tier 2 geographies. Now we're seeing, AI builds happening wherever they can find land and power. So there's just a lot of need for capital, and what that does is when we think about, data centers are also growing in size. So what used to be a 50 megawatt data center that was supposed to be large 5-6 years ago, we're seeing single asset build outs of 300 megawatts plus, which looking at today's cost, that's roughly at least $3 billion, obviously more than that in need for capital. So that capital needs are growing, and banks have been the power horse in this sector and providing a lot of that capital. But as new data centers need new capital, that capital needs to be recycled. So this year, we did see the first private placement deal, for example, on the data center side, which attracted insurance capital within US that invested in that space. SMBC was one of the lead arrangers on that. So Tobias, maybe if you want to give some details later on, but that was one of the marquee transactions that got done. The ABS and the CMBS markets have been very active for data centers in the US, and they will continue to be active. But I think when you look at the growth, for example, I think in the US last year was about $30 billion thereabouts of data center build-outs. I think this year that number is expected to grow north of 40. You will need every source of capital to help drive that growth. And I think the US, at least what we see in the US, it won't be just one market. It will be a diversified set of markets. And I think it will take, different sets of investors to, one, get comfortable with the asset class, which I think everybody is getting to, but two, be able to deploy and help the growth of the sector.
Yeah. Is it easy to? I mean, take your point about looking for multiple capital sources. Can you isolate suitability? Are there particular investor types that are particularly who are particularly sort of aligned with investment in data centers? So is it insurance capital? Is it more specialist capital? Perhaps infrastructure platforms? Is at this point, can one say?
I would say it's a combination of everything. So for example, I think data centers is also that one asset class that converges real estate and infrastructure. So you'll see a lot of real estate investors, obviously with the likes of CMBS, but even just traditional real estate lending is still, they're supportive of the asset class. Insurance capital has a huge need, with the private placement transaction that got done. That was well oversubscribed with insurance capital. And I think there will be more insurance capital that will come into this space. I think in today's world, duration is a big need for a lot of insurance investors. And, if you think about the types of assets that data centers are like, long leases, long useful life, you can add a little bit of duration to some of these assets, and that could make sense for insurance capital as well. So when you think about the universe and think about the types of investors, data centers can fit into many different categories. It really depends on, what kind of data center is it, how is it structured, what part of the life cycle is it in? Obviously, construction data centers will fit a different investor base than stabilized. So, but it is an asset class that I can argue is for many different types of investors.
And if I may, is Aptera, are you a buy and hold investor?
We are.
What's your kind of orientation? Yeah,
we
okay.
are. Yes. Yep.
Understood. Okay, thank you, Said. In terms of what we might expect to looking forward, wanted to move to talk a bit about the road ahead and the state of the European DC market, including the challenges. And of course, we haven't mentioned as yet ESG, which has become a very, very big part of this conversation. So Benjamin, can I move to you perhaps to kick us off on this section, and you've got a couple of slides you can run us through.
Yes, so as you can see here, we do have a current FLAP-D market, current IT load, FLAP-D standing for obviously Frankfurt, London, Amsterdam, Paris, and Dublin. These are the main data center markets around. At the moment, it's about 3,250 megawatt that is actually running. With that's equivalent since 2016 to a 15% annual growth rate, which is per annum, which is quite significant, as you could imagine. No surprise, I guess, for the audience, from social media to video streaming, but also driving to work with your electric vehicle, or even subscribing to your favorite, hopefully, Scopes rating newsletter. You will have data around. You definitely need data, and for that, you need more data centers. As you can see on the right-hand side, on the IT load that is actually under construction and planning, that's about 3,500 megawatt. That is actually in either under construction or in the planning phase, which, as was discussed earlier, will be difficult to securitize, but obviously will be live in a relatively short time frame. That's actually that's actually the whole current IT load of 3,250. But that's also to put into perspective the total expected both current and under construction and planning size of 6,500 megawatt is equivalent to the most efficient nuclear power plant in France. And we are the leaders in nuclear energy, so that says a lot. Clearly, power is very important. Sourcing the power will be, if not essential, to be able to rate the transaction, but also constrain with the regulations. We've already heard that some UK regions blocked some data centers to actually get access to power and so on. So it's complicated. Obviously, all governments want to prioritize other type and more social type of electricity consumption. Nevertheless, that's actually quite important. What have we actually seen rated in Europe so far? Well, just the 148 megawatt from Vantage. That's actually much, as you can imagine, lower than the current IT load, about 40 times lower. So there is room for new deals. As Syed said, also, we do have actually some for everyone, from construction financing to stabilized asset financing, strong tenant quality, gradual tenant quality with collocs, for example, long duration, short duration. Everybody can get some, and that's why I think we are poised to see more data center securitization. And actually, there should be taking over logistics as the most securitized asset within a very short time frame. As Tobias said, CMBS are used to multi-jurisdictions transactions. There's actually been one very recently pan-European logistics asset, and what's not to like when you have a very strong tenant quality, very long weighted average lease to break, and also such a compelling tailwind in regards to AI and also data all around the world. I guess we can move to the next speaker in regards to ESG and how they plan to implement more sustainability in their data centers, especially in regards to the batteries, how they want to make sure that the PUEs, that is the efficiency of power utilization within each data center, is actually very strong, and so on. Guillaume, maybe?
Okay, Benjamin, anything, do you want to comment on this particularly on the slide, or should we move on?
Well, on this slide, it's actually speaks for itself. The poor volatility cost in the UK has actually been spiked during the conflict with Ukraine. No surprises. We all know what happened with the gas and the fact that the UK is behind in regards to nuclear power. France also saw some increase, and that's because most of the reactors were offline. Not that they are actually back online, the price is actually going down. I was surprised to see Spain so low, but obviously they also have more solar panels and so on top of their data centers, which may help during the day, but obviously at night when everybody is streaming their videos won't help much. But that's where batteries and more storage, electrical equipment actually have to come into play, and that's why we are actually seeing more and more private equity firms also buying companies that actually will be helping the AI revolution and bringing down the cost for the tenants in regards to the power consumption.
Yeah. Okay, we actually got a question which I'd like from one of our viewers, which I'd like to perhaps just throw out to the panel in general, and please feel free to take the question. The question is, I'll read it out. It says, with Google's recent decision to invest in small nuclear reactors to power its AI data centers, clean energy solutions are clearly gaining momentum in the tech industry. From a European perspective, how do you see the region adapting to clean energy sources like SMRs for powering data centers? And this, of course, topic has been very much in the news recently. I don't know. Can I just throw that out? Guillaume, do you have any perspectives on the power sources?
Yeah. For the vast majority of our projects across Europe, we are directly connected to the grid, right? So the energy mix that feeds our data center is the energy mix that is available in the region. Now there are a few areas where demand is really strong and there is just no power available, where you have to be a little bit creative. We've talked a little bit about nuclear power. It's real. So you've all seen the news about Microsoft a few months ago. Google was in the news on the topic a few days ago as well. So it seems to be at this stage the solution that people are contemplating. We'll see. I think it's going to be quite challenging from a permitting perspective, right? To have local governments signing off on nuclear reactor being, close to their cities is going to be a challenge. I'm sure the federal government will be supportive of some of that. TBD on local. But yeah, people seem to see that this is a solution, and you have, beyond the drawing, right? Contracts are being made. People and
Actually,
if I may step in, actually, I think in Europe we are a bit far away on the nuclear power stuff. Obviously, indeed, as Guillaume said, when we talked about Microsoft actually going on the market for 3 Mile Island, which is actually a nuclear site, but actually, like Chernobyl, had an issue. I don't see any company in Europe trying to make Chernobyl work again for a foreseeable future. It's going to be very complicated, both in terms of regulations, but also getting everybody on board. So I guess we are not there yet. Clearly, all the data centers have to be located close to or a strong power supply and have connectivity to the grid to be able to be rated. As we just discussed, it's complicated to build it on a speculative basis and just hope that you will get on the grid. Island being obviously self-generated for Vantage, it actually makes sense, but sustainability is important for investors too. Clearly, from both the tenants that are actually in the facilities, they all want exceptional standards. That's also why CWA 11 and 12 from Vantage were actually so strong. It's because they are fully pledged in terms of green sourcing for the energy by Total. So that's actually what was a strong sales pitch for Vantage on this facility. And I guess that's everyone else also concerned when they want to enter into such a data center.
Saeed, can you give us a flavour of how that discussion is evolving in the US, where I guess a lot of the conversations have been taking place around nuclear and power generally?
Yeah, I would say it's the conversations are happening. SMRs are a potential solution, and I think it could be one of the more viable solutions in the future. Though the challenge is that we won't see it tomorrow. It will probably still take the next 5 to 10 years to get there. And when we look at how much demand and deployment is going on, obviously we still need to solve that problem today. So I think SMR is something that could happen in the next decade. I think until then, and even with more renewables coming on, we still need to bridge that somehow. And obviously we're seeing grid congestion in a lot of geographies with heavy data center usage, i.e. Northern Virginia in the US, which they're having some transmission upgrades there. But I think we'll need some bridging power, which would be most likely natural gas. And until we, and once that's solved, then I think SMRs could be in the future. Obviously needs a lot of approvals, as mentioned, needs government support as well. So, but I think as these data centers come online and the needs grow, it will definitely happen. I think maybe the talks are in more advanced stages in the US than there might be in certain parts of Europe, but it's definitely happening in the US.
Okay, and can I ask just a quick word perhaps on how important the green aspect of financings are? I guess the discussion in the US has a slightly different flavour to the discussion in the European Union for sure, but generally speaking, is that something you would look to as standard, or is just an added dimension?
I would say we definitely look at it. I think sustainability and ESG, obviously go hand in hand, and we need to make sure wherever we're deploying capital, there is some form of an ESG or sustainability story. We understand that it could be different for each asset and where it is, and the relevant PUEs and what kind of cooling and technologies they're using. But in general, we need to just see those metrics in the right trend. So it's not, I would say, the topmost factor, but it's something that we think about.
Okay, Adam, and just in terms of the rating process, again, do you just want to talk briefly about the green aspect and to what extent that was that an important aspect of the overall transaction, or were the other points that you brought up earlier the key drivers of the rating process?
Yeah, in general, the green aspect is relevant for our ESG type of analysis, which is not directly part of the quantitative analysis. But qualitatively, it can clearly strengthen the rating. From the quantitative perspective, in terms of assumptions for potential costs, it can be a contributing factor if we assume that the costs will not increase because the sources are so reliable and green, then yeah, absolutely, this can also contribute to make sure that in the assumptions we do not have any kind of punitive assumption which would negatively impact the rating.
Okay, thank you. I just wanted to then perhaps move to our Q&A before we close. We need to close in a few minutes. And there are a couple of questions that have come in. And I guess there's one here aimed at Benjamin and Adam. And I'm not sure how appropriate it is to ask, but I'll ask it anyway. And if you can't answer, then I guess we can circle back to our question of one-on-one. And the question, have you seen requests for ratings for Nordic players at all, for the bond market or otherwise? What you're thinking for smaller players and how much they are generally penalized in your ratings? I'm not sure if that's an appropriate question, but there we go, that's what it is.
No, it is. I mean, obviously, we've been approached by a lot of issuers after the Vantage transactions. We have a lot of discussions both with investors and arrangers and issuers. It's not really a question of penalizing smaller players. It's really depending on the asset quality and the tenant granularity. Here, I guess they are all Colox transactions, so they are more granular, but the tenant base is not as strong as if it was Microsoft or Google or AWS. Cloud services. So clearly, it's a deal. Again, that's the beauty of CMBS. It's a deal by deal case. And property also dependent. But clearly in the Nordics, it's actually a very strong place for data centers. It's cold. They don't have to spend as much money to actually cool the whole system, albeit obviously they still have to some extent, but it's not as expensive. And they also have as I think the question above in regard to geothermal power is actually also available there. So that's a strong ESG features. But no, we don't penalize for smaller players. It's obviously deal dependent.
Yeah. Okay. Thank you. And there's a question. And the question is, except for getting investors comfortable with the DC asset class itself, what was the next biggest concern/hurdle to get investors comfortable? And the question ends, obsolete tech.
Yeah, look, on during our one-on-one, right? So we talk as Tobias just mentioned, renewal risk a little bit. I think people got comfortable quite quickly. People also get comfortable around the quality of the contracts and the quality of the off-takers. Some discussion about ESG, but nothing really major. I'd say maybe one element to mention is the tax analysis. I think that was one of the biggest piece of due diligence with the rating agencies. So as you guys know, right, the CWL ABS wasn't done through a clean, newly established SPV, but through entities that are already in place. And we spent months running the rating agency through the tax structure and making sure that there were no outstanding or a risk of future tax liability within the structure. And that's something that we really didn't think about much going into this transaction, right? So obviously a tax work stream was there as part of the due diligence list, but it ended up, requiring a lot of manpowers and resources to get people over the finish line.
And if I
Okay,
may
thanks,
step in
Spencer.
actually on the
Yeah.
obsolescence actually, so just bear in mind that the tenants are actually entitled to change their equipment. So the main tenant here actually has to update their chips if they want to and need to. Obviously, you can see the waiting list for the Blackwell chip from NVIDIA, so it's not going to be tomorrow. But at the same time, in terms of obsolescence of the building itself, given the strong ABR, I mean, net revenues for the property itself, they have enough cash to invest in some capex if they need to improve the cooling system and improve the PUEs to a better standard. But the obsolescence of the technology itself, it's up to the tenant to make it work. So that was actually quite important.
Yeah. So the way it works is that the customer lease will clearly define what are the network slash setup of the data center that Vantage needs to provide in order for the rent to be claimed. And that is static, right? So once Vantage has provided that setup and the tenant has declared RFS, i.e. that rent can start to accrue, the specifics of the infrastructure that Vantage has to provide do not change, right? So if you have a 15-year lease, it doesn't really matter what type of technology changes happen, you are still fully entitled to get the rent. Now, even in an hypothetical scenario where, say, in 10 years, that data center needs to look completely different, which might be the case, then what would happen is you would just sit down with the customer, they would explain what layout they need, that would translate into CapEx, and then you would back solve that into your new rent and a new lease with a longer tenor if needed.
Okay, I'm just going to get through a couple more questions, and we do need to close pretty soon after that. Again, the question here is back to power. Does a power issue mean locations with cheap geothermal power have an advantage for future DC build-out? Anyone have a view on that? Guillaume? Otherwise, we'll move on.
I could start.
Keith, I heard thermal power. Could you repeat the question, please?
Yeah. Does the power issue mean locations with cheap geothermal power have an advantage for future DC build-out?
Look, I think it really depends on the application within the data center, right? So if you think about a cloud business, latency is massively important. You need to be somewhat close to where the data is either consumed or produced, and that's why the FLAP-D market is the largest market in Europe, because that's where there is the most data activity. Now, if you take, say, an AI application, right, where it's say the training of a machine, right, over 5-10 years, and that can happen anywhere, then yes, the location of the data center will be way more driven by where power is available and how cheap it is to build and cover the costs associated with the data center, i.e. operations and power. So that's why you start to see, say, 500 meg plans in North Dakota for those applications, right? Whereas 2 years ago, no one would ever think about North Dakota as a DC market. So look, short answer is that's really dependent on the application that the data center will host.
Okay, Syed, were you going to comment as well on that, or did I?
Guillaume covered it. That makes sense.
Okay, all right. Okay, look, there's one more question, which is quite a specific one, and I think it's probably one for Guillaume, but maybe perhaps others may want to comment. And the question is, what's a typical period for the fit out of the shell? for example, mechanical and electrical, generator and cooling systems. Any possibilities to mitigate risk of delays? And a few words, the questioner says kindly, to power supply agreements, annual escalators, question mark, annual power usage pass through to customer, reliability. It's such a big question, but with potential different answers. But
happy to give the very high level answer, and then other may comment. From a construction perspective, it takes roughly 24 months to 18 months to build a data center from A to Z. Think about it as, say, a year for the shell and core, so the box, and then a year for the MEP feed out, so the mechanical, electrical, plumbing, and whatnot that goes inside the box. On the power side of the question, I didn't catch everything, but some of it was around who foots the bill for the power. That is entirely passed through, so to the tenants. So the hyperscaler, i.e. Vantage, doesn't carry any electricity price risk, because we don't even pay those, right? The bill just goes straight to the tenant. On how do you mitigate delay risks? I think that's just your generic answer around how do you make sure that construction doesn't go wrong, right? So you just need to make sure that you have experienced partners, right? So both on the data center operator side, so Vantage, two on who's going to be your GC, because the general contractor is really who's going to do the heavy lifting from a coordination perspective, contracting perspective with the subcontractors. So are those guys, solid? Have they done it in the past? Do they have the resources internally to carry out those projects? Because data centers are no small feats, right? On certain days, on the largest construction sites, we have more than 1,000 people on site. So you need solid capabilities to manage all that. I think that's it.
Maybe I'll add, Keith, just one quick one on that. As an investor, when we come into construction transactions, obviously the mitigants are a huge factor for us to get comfortable. The availability of labor is obviously a key part of that. But then going back to the mechanical and electrical completion, I would say maybe one of the challenges that the DC market is facing today is just procurement of equipment. So there's a long lead time on procuring generators and equipment, and that could delay the timeline, not from an actual construction standpoint, but really the procurement part. So we would like to make sure that, obviously those orders are in and they're in queue to actually receive those equipments. I think the fitting out part, and Guillaume could maybe attest to this, is maybe the relatively easy part. I think procuring these days is the challenge.
Yeah, okay. Excellent. So I think in the interest of time, we're slightly over our allotted 1 hour. I'd like to close the session now. So thank you so much to everyone who dialed in and watched our session. I actually learned a lot today, so a particular thanks to our speakers. Thanks Guillaume, thanks Syed, Tobias, Benjamin, Adam, for your time and your engagement. Great session. And before we do go, I just wanted to say two things. That this session will be available on social media, either for you to watch again because it was so good, or you wanted to pass it on to other people in your organizations. And then if you wanted to download the PowerPoint presentation that we showed, you just need to go to the bottom of your screen and click on apps, and you'll see a pop-up saying handouts, which if you click on that, hopefully you shall see, there it is, the PDF is available for download there. So while you do that, I'll just say thank you to everyone again. Great session. I've got a feeling that as this market scales up, we'll be back with more similar sessions at an appropriate time. So until then, it's goodbye from us and enjoy the rest of your days. Thank you.